Imagine walking into a casino where the rules of physics have suddenly just ceased to exist. You've spent your entire life studying the trajectory of the dice, the weight of the cards, the statistical probability of a win, right? Only to realize the house is now being run by a combination of high-frequency math nerds and a viral thread on Reddit? Welcome to The Explainer. Today we're unpacking a literal structural earthquake in the financial world. We have entered a completely new era of the algorithmic shift, where the traditional tools of investing aren't just outdated anymore, they've actually become a liability for anyone trying to navigate the chaos. So let's dive right in.
For nearly a century, the stock market was anchored by this concept we call gravity, the fundamental reality of intrinsic value. It was this idea that eventually a company's value was undeniably tied to its earnings, its cash flows, and its, boring adult balance sheet. And sure, markets have always had their manic phases, we know that. But sooner or later, gravity showed up. Intrinsic valuation actually mattered. But something shifted around 2020. The anchor didn't just slip, it was completely cut loose.
To see just how wild things have gotten, take a look at Michael Burry. He's the guy who famously predicted the 2008 housing crash and made an absolute fortune betting against the world when literally everyone else was blind. Burry is the ultimate fundamentalist, okay? He believes in the math of the real world. Yet, he recently shut down his hedge fund, basically throwing in the towel. When the man who saw the greatest crash in history says his estimation of value is no longer in sync with the markets, that assets just aren't priced based on reality anymore, we have to ask a pretty terrifying question. If fundamentals aren't driving the bus anymore, who is?
To answer that, here is our roadmap for today's explainer. We're going to look at the narrative machine, the math machine, the death of the middleman, and finally, we'll tackle the trillion-dollar question. This is basically our blueprint for understanding this new regime and the bizarre pincer movement that is squeezing traditional investing totally out of existence.
Okay, Section 1, the narrative machine, when psychology replaces spreadsheets. Let's look at the first massive force taking over the market.
So if fundamentals are dead, behavioral finance has totally taken their place. For decades, traditional finance just assumed markets were perfectly rational, but pioneers like the psychologists Daniel Kahneman and Amos Tversky proved that we humans are anything but rational. We evaluate risk terribly, we fear losses way more than we value gains, and we anchor to stories and narratives instead of actual numbers. For the longest time, Wall Street treated behavioral finance as this fringe academic theory to explain the occasional weird market bubble. But today, it has literally become the operating system of Wall Street itself.
And technology has basically poured gasoline on all that human psychology. Human emotions have always affected markets, for sure, but they used to be constrained. Information moves slowly. But today, you can wake up, read a hot tip on Twitter, and deploy capital before you've even brushed your teeth. Social media totally collapsed the distance between information and reaction. Narratives don't take months to spread anymore. They spread in hours, moving billions of dollars before a traditional analyst has even had a chance to pour their first cup of coffee.
This incredibly volatile cocktail of behavioral finance and social media has turned the market into a living, breathing psychological experiment. Ever since 2020, fueled by zero interest rates and this massive flood of new retail investors, the old mantra of investing for the long term has entirely morphed. Buying the dip is no longer just a strategic maneuver. It's become an unshakable, almost religious belief. Momentum completely overpowers valuations, and prices move entirely independent of the fundamentals.
Which brings us to Section 2, the math machine, the quant takeover. Because while everyone is busy watching memes drive stocks to the moon, a totally different kind of revolution was happening in the shadows of Wall Street.
See, old Wall Street was run by suits with gold watches and gut feelings. You know, the classic Gordon Gekko archetype who bought a stock because of a hunch. But the new Wall Street? It is run by math nerds. People with Harvard PhDs and dreams made of probability distributions. These quants, pioneered by guys like Jim Simons, realized really early on that markets aren't actually random. They are just patterns of human behavior that repeat, and they can be exploited at the speed of light.
To put that into perspective, compare these two approaches. You've got Warren Buffett, the absolute king of fundamental value investing, averaging around a 19% annualized return. 10 grand with him over 20 years gets you about $324,000, which is not bad at all. But then compare that to the Medallion Fund, a mathematical powerhouse utilizing pure algorithmic quantitative strategies. 60% annualized returns before fees. That exact same $10,000 turns into over $7 million, leaving even Warren Buffett in the dust.
These algorithms, they don't care if a company makes a great product. They don't care about a strong CEO. They literally only care about statistical variables, order flow, and volatility.
And because these machines operate at microsecond speeds, human brains simply cannot compete. The result? Roughly 90%. That is the staggering percentage of active human equity fund managers who consistently underperform their benchmarks over long periods. When you factor in the fees they charge you for the absolute privilege of underperforming, it is super easy to see why the traditional stock-picking money manager is quietly going extinct.
And that leads right into Section 3, Death of the Middleman, the Rise of the Robots. The average investor was suddenly caught in this bizarre pincer movement. On one side, Reddit threads are moving markets. On the other side, supercomputers are executing millions of trades a second.
So where does that actually leave the traditional financial advisor? Well, it leaves them being replaced by robots. Enter the robo-advisor. These are automated platforms that handle all the boring operational stuff: asset allocation, tax optimization, rebalancing, without the hefty 1% management fee your traditional advisor used to charge you just to essentially run an Excel spreadsheet.
And the adoption has been absolutely explosive. Just look at Wealthfront. 10 years ago, they had about $2 billion in assets under management. Today, that number has skyrocketed 40-fold to $80 billion. Globally, we are talking about trillions of dollars moving into these automated platforms. This represents a massive structural shift away from human managers, simply because that old information asymmetry has completely vanished.
Now, there is a bit of an illusion at play here. These platforms, they ask for your age, your income, your goals. It feels incredibly personalized and thoughtful. But in reality, it's really just categorization. They aren't some hyper-intelligent AI crafting a unique, bespoke portfolio just for you. They are simply slotting you into a pre-made bucket with thousands of other users. They are highly efficient replacements for the middleman, doing exactly what a human advisor did, just way cheaper and way faster.
Think about the travel agent for a second. Travel agents didn't disappear because people stopped going on vacation, right? They disappeared because booking a flight online suddenly became free and easy. Stockbrokers are facing the exact same fate. When technology finally touches a stagnant industry, and when access becomes free, the middleman is completely replaced. It doesn't just make small tweaks, it forces an absolute regime change.
Which brings us to our final part, Section 4, the trillion-dollar question, bubble or new regime. This is the existential climax for literally anyone managing a portfolio today.
We have to confront a core philosophical shift here. The old reality was that markets were a weighing machine for cash flows. The new reality? Markets price attention. Have frictionless trading, social media, and massive automation permanently changed the anchor of the financial world from actual capital to pure attention?
So this is the big thing you should take away from this entire explainer. Are we just living through a good old-fashioned behavioral bubble where fundamentals will eventually show back up like gravity? Or have the machines and the narratives permanently rewired the system? Because if gravity isn't coming back, then sitting around waiting for it is a really dangerous game, especially while the rest of the world moves onto a system where math and narrative are the only valid currencies.
And here is a pretty mind-bending thought to leave you with. The real irony of this entire situation is that even sitting here debating whether the market is broken or in a bubble is likely just another part of the herd psychology driving its next move. We're essentially trapped in the exact same behavioral loop we are trying to analyze. Crazy, right?
Look, if you want to survive this new regime, you might just have to stop looking at the balance sheet and start looking at the ghost in the machine. I really want to know what you guys think. Is this just a temporary fever dream, or is this the permanent new architecture of wealth? Will logic ever return to Wall Street? Drop your answers in the comments below. I'll be reading them. And if this explainer changed how you view your portfolio, make sure to hit that subscribe button. Thanks so much for learning with me today, and I'll see you in the next one.